I now hand the conference over to Mr. Deepak Jain. Thank you, and over to you, sir.
Good afternoon, ladies and gentlemen. A very warm welcome to the Q1FY21 earnings call of Lumax Industries Limited. I wish everyone is healthy and keeping themselves safe from the pandemic. Along with me on this call, I have Mr. Anmol Jain, Joint Managing Director, Mr. Vineet Sahni, CEO and Senior Executive Director, Mr. Sanjay Mehta, Group CFO, along with his finance team, Shruti Kant and Mr. Ankit Thakral, and also Mrs. Priyanka Sharma, Head Corporate Communication, along with SGA, our Investor Relations Advisor. The results and investor presentation are uploaded on the stock exchange and company website. I hope everyone has had a chance to look at it. Before we start with discussion on the financial performance of the company, I would like to share the few highlights of the automobile industry. With each passing month, the auto sector revival signals are getting stronger. With strict lockdown to ease in lockdown, companies have reported nil revenue in the month of April to considerable growth in month-over-month numbers. Supply constraints and strict social distancing norms led to lower capacity utilization, which is now showing signs of improvement. The road to normalcy is going to be a challenging one. With easing lockdown restrictions and improvement in demand, OEMs across the industry have reported substantial pickup in sales in July 2020. Majority of the demand is coming from two-wheeler and private car segments. People who used to travel by public transport prefer traveling in their own isolated space now as a matter of hygiene and safety. However, auto sector recovery is yet to experience full normalcy. Economic activity will remain below the pre-pandemic levels in the near term. As I mentioned in the previous calls, various auto industry associations have requested government for stimulus and demand boosting policies like the scrappage policy. The recent Vocal for Local campaign will lead to increased outsourcing by OEMs, leading to higher utilization for Indian auto component manufacturers. If this call was to happen in pre-COVID times, this call might have had more discussions on transition from BS4 to BS6. Also, as you know, that the BS6 norms were implemented amongst the recent lockdown. Despite COVID, we hold a view of generating about 50% of our revenue from LEDs over the next 3 to 5 years. New product launches during this quarter we had were the following. In the two-wheeler segment, the BS6 models of Piaggio Vespa VXL and XXL model, and also the HMSI Gracia model, all had LED headlamps supplied by Lumax. In the commercial vehicle segment, Lumax LED lighting is a part of Tata Winger headlamp and tail lamp. It can be clearly seen that the new product launches is following a trend of LED lights over conventional lighting, and we are confident of increasing our market share from LED segment at a faster rate with wide range of LED lights through our know-how, R&D team, and strong partnership with Stanley Electric Japan. During the lockdown period, the company was recognized in the following categories. The Dharuhera plant received the GIPM PPM Award for Excellence in Category A for the year 2019. The Chinchwad plant was awarded the first place out of 51 teams participating in the top 3 categories at the ACMA QCC virtual competition held in August 2020. I would like to place on record a deep gratitude to our esteemed customers, supply chain partners, and all our associates who have risen to the challenge of COVID-19 during the quarter to quickly stabilize the company operations. Now, I would like to hand over the line to Mr. Sanjay Mehta, Group CFO, to update on the financial performance of the company.
Good afternoon, everyone. I will just update on the operational performance for Q1. The share of LED lighting stands at 30% of our total revenue, and that of conventional lighting stands at 70% during Q1 FY21. The product mix for Q1 as a percentage of total revenue is 68% of front lighting, 22% of rear lighting, and 10% others. The segment mix for Q1 as a percentage of total revenue is 67% passenger vehicles, 25% two-wheelers, and 8% commercial vehicles. Now, I will just update on the consolidated performance. Due to the outbreak of the COVID-19 pandemic and the consequent lockdown announced by the Government of India, due to which the operations were suspended for part of the quarter and gradually resumed with requisite precautions. Thus, results for the quarter are not comparable with those for the previous quarters. The revenue stood at rupees 78 crores for Q1 FY21. April was completely washed out. 15% of the Q1 revenue was achieved in May 2020, while the balance 85% was achieved in the month of June. We have witnessed substantial recovery in June and the momentum continued in July 2020 as well. Manufacturing revenues for Q1 stood at 74 crores, while the balance was mold sales. The consolidated EBITDA loss is rupees 32 crores for Q1, vis-a-vis gain of 39 crores in Q1 FY20. The consolidated PAT after share of associates stood at rupees 32 crores in Q1 FY21. That is all from my side. We will now open the call for the question.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Varun Bakshi from Equirus. Please go ahead.
Hello. Thank you for the opportunity, sir. So my first question is regarding our customer revenue split in 1Q. So for 1Q, the revenue from HMSI has come down significantly. Is it largely because of higher inventory that was there in the end of March, or what led to such a steep decline?
So this is Anmol Jain here. So largely because HMSI did not start the production in Q1 substantially. If you look at April, May, and June, the numbers are absolutely minuscule, and they were all obviously doing their inventory corrections as well. So that's primarily the reason why our revenues for HMSI in Q1 is also negligible or close to nothing. So this is Deepak here. I just want to add a little bit structure. You know, if you see, Q1 has been an exceptional and abnormal, I would say, quarter. And I don't think it's kind of comparable even to Q4. However, I mean, say, just to give a consensus, after 90 odd days of basically Q1, we actually were shut down almost on an average of about 43 days. You definitely see a better tick from Maruti Suzuki and Hero, and that is primarily because both being leaders in the rural segment, having an outreach, and also on the entry segments vehicles, their recovery in the month of June has been much better. Also, for the company, the revenue which we did in the month of June almost consists of 82% of what we are reporting for the quarter. And hence, you can see that there would be probably some anomalies in the current customer share segment because some customers had delayed their production startups. However, in the long term, or even in the midterm, we see that once the operations of all the customers are normalized, more or less, we will remain stable on the customer rankings, which were probably for the same as what it was in the year of 1920. So our top three customers will still remain as Maruti Suzuki, HMSI, and Hero, and also along with Mahindra and Tata Motors. So we don't see a very significant shift on the ranking, but these 5 will remain a top 5 car.
Sure, sir. So also if you could provide more color on how the demand is shaping up in, say, July and August, and what kind of utilization have we reached in these currently in the month of August?
So I think we have seen a better than expected recovery in the month of July as well as in the month of August. We are seeing an improvement, although we still have not gone in terms of the complete utilization, because you have to see as a total, we were 20% down from last year, and then we will probably, overall for the year, we will contract. However, if I compare it with basically the manufacturing revenue for the month of July, vis-a-vis what it was for 19-20, we are down 20%. August, probably about 4%, and September, we expect to have a positive as compared to last year's September. So we definitely see a better than expected recovery.
Okay. So also, if you could provide any update regarding the new products like HVAC panels from Stanley that we were looking at, if there is any kind of a development over there?
Well, Amish, the HVAC panel remains as a product which we will be having a launch with our partners. Currently, we are discussing with our customers, and our plans remain basically the same. There are no changes because of the COVID to basically launch this going forward.
Okay. So do we have any confirm orders for the HVAC panels from our customers?
We are currently under discussion. Then once we have this thing, we will be able to let you.
Sure, sir. Sure, sir. Thank you, sir. That's from my side.
Thank you. The next question is from the line of Kishan Gupta from CD Research. Please go ahead.
Good afternoon. Dhagesh Shah this side. So what sort of integration do you have between different business units, that is two-wheelers, four-wheelers, commercials?
Can you please elaborate what you mean by integration?
Integration as in what sort of integration between production, administration, and those sort of things?
So all our manufacturing, so this is Anmol Jain, all our manufacturing locations are not specifically addressing any particular segment. The processes are common, and within an infrastructure, there are different production lines which cater to passenger vehicles, different for two-wheelers and different from commercial vehicles. I would say that almost close to 75% of the production process would be common, and just the final assembly would be different based on segment demand and the segment requirements of the product. So there is a fair bit of backward integration of the processes across segments.
All right. So, with regards to raw material and designing, can you throw some light on that as well?
So I think currently, Lumax Industries is one company with lighting. Although we are leaders in the lighting segment in the country, I think it is a company which actually offers product lighting for all segments, be it CVs, passenger cars, two-wheelers, and agriculture sector, right? Second, if you're looking at in terms of the processes, we make lighting, and all our processes, there are 3 major steps of the processes. It is injection, surface treatment, and assembly. All our plants are equipped to have all these processes internally. And as Anmol just explained, that all these processes are used for all the segments. In terms of the technology, R&D, we have basically a partnership with Stanley Electric, as well as the company has 3 R&D centers in Gurgaon, in Pune, as well as in Taiwan. And we use that R&D localized capability to cater to all our product development for basically the customer requirements for the Indian market. So we have that engineering capability as well to do that.
All right. So how much of your lighting systems can be replicated by unorganized players for the replacement market?
Well, Amish, from the unorganized player, you have to understand that obviously there is a regulation and there is enforcement. Over the years, we have also been using our, let us say, regulations to enforce not just, I would say, aftermarket issues, which we found curiosity issues, but also actually educate the consumer to use basically the OEM products. But if you see now, as the technology is shifting and it's becoming more and more LED oriented, the tooling investment and the technology investment is becoming more and more, and hence it becomes more difficult to basically get it replicated by the unorganized market.
All right. Sir, is it possible to put some sort of rough figure or some sort of percentage on the question?
I don't think we will be able to put estimate in terms of how much we can basically be replicated unorganized market or not. I can just give you an analogy. A commercial vehicle, old 1210 Tata truck, which is still on the roads, used to have a sheet metal and a reflector and a glass lens. Today, Amish, a similar type of Tata, the new launches are having a complete revamped new product, which is completely having plastic, electronics, and hence it becomes impossible for the aftermarket to replicate it in an unorganized sector.
Fair enough. So what sort of difference is there between revenue and profitability in terms of front and rear lightings?
Vineet, would you like to take that?
Yeah, I will take that. Hi, this is Vineet Sahani. So again, there is no direct answer on fixed profit percentage on front and rear. It all depends on the content of the lighting. For example, today rear lights are also moving towards LED, and front lighting is also moving towards LED. But front lighting is slightly more profitable, but more capital intensive also, as compared to rear lighting. And therefore, you would see that Lumax portfolio, we have a higher share of front lighting as compared to rear lighting.
All right. No, my reason for asking that is so that front is close to 70% of revenues and back is close to 22%.
Yeah.
So can you elaborate some further on that, sir?
So we have
front. When you're looking at the distribution about front and rear, please also understand that there is almost 1/3 play of the two-wheeler. And in the two-wheeler, there isn't much substantial difference between a front and a rear lighting. In the passenger car space, of course, there is a huge difference both in terms of technology or even the contribution and the revenue per vehicle. So it is very difficult to give you a black and white picture in terms of front lighting is more profitable or rear lighting. There are various scenarios where we see the rear lighting on certain models are more profitable than the front, and vice versa. Or in some cases, both front and rear fetch similar margins for the company.
Just to add on to your question, a quick add on that rear lamp requires lesser technology, the old types, and therefore there are more number of players in rear lamp as compared to the headlamp. The quality requirement and technology requirement for headlamp is much higher, and therefore you see a little distribution of head as 70% and tail as 22 or 35%.
All right. That's very helpful, sir. Thank you. So just lastly, if I can fit in, how much surplus capacity do you need at any point of time? Do you have to keep? Is there any such requirement?
So normally we plan our capacity at 85% to accommodate the peaks, 85 to 90%, 10 to 15% we keep for the peak season. For example, my production requirement may go up in OEM during festival seasons. So that is how we do the planning.
All right. Thank you so much, sir.
Yeah.
we would request the participants to please press star and one to ask a question. The next question is from the line of Sanjay Shah from KSA Securities. Please go ahead.
Good afternoon, gentlemen. So my question is regarding our electronic plant and Bawal facility, and how much, what is the progress in that? Because last time you cited about some delay. So we see a lot of opportunity, and you will agree with me on auto electronic side. Can you highlight, sir, on that?
So, Vineet, you can please take that question.
This is regarding electronics. So electronic is growing up as we had shared earlier. So the new products are moving towards LED, and therefore whenever it moves towards LED, so PCB comes into picture.
Yeah.
And that is why PCB is being designed in-house, and that is supporting us in our process. So anything else you want to know, just let me.
I think you want
to know what progress are we? Are we with our strength? Are we doing any capex and coming out with new products on that side and enhancing the capacity and new product facility?
Yeah, we are setting up. I think we shared world-class infrastructure in electronics in a place called Bawal near our plant, and this should be functional in Q1 of next year. We postponed it because of the current condition. The infrastructure is ready. We would be creating this facility, which is one of its kind in electronics, and this should be functional in Q1 of next year, because as we see a good potential coming in electronics.
What is the capex we have spent till now, and what balance capex are required to be spent on that side?
So, Sanjay, if you could support there, the balance is how much?
Actually, the 75 crores we are spending on this project, and almost we have already done the capex of 50 crores out of that amount. The balance is already purchase orders are there. So during this year, we will have the expenditure around 25 crores on this project.
Thank you. That's from my side, and wish you good luck to you, sir, and have a safe health.
Yeah, thank you.
Thank you. The next question is from the line of Abhishek Jain from Untitled Chapter. Please go ahead.
Good morning, sir. Thanks for taking my question. So, during this quarter, there's a significant jump in material expenses to sales. Is it because of the finished goods inventory where non-material expenses added, or is it because of the increase in RM prices?
Mr. Mehta, would you like to take that, please?
Sir, it is because of the inventory was there. Okay, basic reasons of that.
So no, non-material expenses also added in this part, in raw material expenses.
Sir, actually, if you see the sales, which is as explained, is not at all in the quarter. So definitely the dispensing requirement, all these things, it increased all the expenses with raw material, with other expenses.
Okay.
Capacity utilization is not there at all.
Yeah. So how much is the current inventory with you, which need to be liquidated in second quarter?
So we are having the inventory of almost around second quarter. It is in the first quarter. We began with almost around 250 days. Now it is almost around inventory. I'm talking about the raw material inventory. Finished goods is maybe around, if you see the sales volume, it may be around month or around 45 days. Right now it is not almost, it is clear finished goods. It is because the product is ramping up.
And what is the normal inventory?
Normal inventory finished goods we are carrying almost around 8 to 9 days.
Okay. Sir, so your import content is high in LED segment. So what is the arrangement for the rupee depreciation?
So we are not in fact taking them hedge on our import. Okay. Because it is back to back with the customer understanding. So largely we are not going for the hedging of the foreign exchange.
So is it passed on fully?
Pardon?
Is it passed on fully to every customer?
It is largely it is in line of that.
I will let me handle. It depends on the arrangement with the customer. Not all customers have similar arrangements.
Okay.
Somewhere there is back-to-back, somewhere it is negotiation, and somewhere we take a risk of natural hedging.
Okay.
So if it goes down, we don't take from customer. If it goes up, then also we don't take from customer. So it depends from customer to customer.
So what was the forex loss in the first quarter?
So exactly first quarter, I don't think we had enough sales to have any forex loss as such.
So I'm talking about the raw materials inventory and all, because that you have enough inventory right now.
Mm-hmm.
So just wanted to know that how much hit you have taken during this quarter and where it is on.
I think it is not anyone. It is maybe around 1 crore, 2 crores. Because what happened, the inventory was carried on from the. We keep on booking the forex monthly basis.
Okay.
In this particular quarter, it is not that kind that there is any forex loss in maybe 1 crore, 2 crore.
Okay. Sir, as you are talking about the adding two products like HVAC panel and electronic cable as well. So can you throw some more light on how big business opportunity in these products and when can you start your production on this?
So this
Hello.
is Anmol Jain. This
Yeah.
is Anmol Jain. So answering to both your questions, number one, the electronic facility, as mentioned before, is basically for captive backward integration used to manufacture the PCB for the lighting. So to that extent, it is not a revenue generator, but as you have seen in the trailing quarters, the profitability margins of the company have also risen because of this move of backward integration. So that is on the electronic side. On the HVAC side, yes, we do see a good market opportunity over the next 3 to 5 years because most of these products are currently imported. We are right now in the discussion stages with our OEM customers and perhaps also will be entertaining some RFQs shortly. So we do expect that the production of this should start somewhere in FY22, later part of FY22.
Okay. My last question is related with your interest cost that has jumped significantly. Can you throw some more light on it?
Sanjay, can you address that, please?
Yeah, because of high utilization of the working capital limits, because of the disturbance in the working capital cycle in the Q1. But over the coming time, when the capacity utilization is increasing, we are hopefully that it will be reduced substantially way forward.
Okay, sir. Thanks, sir. That's all from my side.
Thank you.
Thank you. The next question is from the line of Vimal Gohil from Union Asset Management. Please go ahead.
Yes, sir. Thank you for the opportunity. Please pardon me, I joined the call a bit late if I'm repeating the questions. Just wanted to understand if, the change in mix that we've seen this quarter from, from the LED lighting mix going down, would you attribute that to largely to your, sales from HMSI going down to nothing temporarily this quarter?
I think
this is the main reason.
Yes, it's fair to assume that not just HMSI, but also in other customers, maybe the models which have really gained traction on production are the entry-level vehicles, which not necessarily have LED lamps. So it's just a model mix, which is the contributor to the lesser LED contribution. But going forward, as things normalize, we do expect things to come back to where they used to be.
The models where we are, the models where the LED content is higher, has as you just highlighted that in probably in August you've seen some revival. Has that revival? Has LED also participated in that revival?
Yes, it has.
Okay, sir. The next question was on gross margin. You've seen a sharp contraction in this particular quarter. This was, as you said, this was driven by maybe higher inventory usage in this particular quarter. What is the outlook there? Do you see gross margins normalizing going forward? And also, are the gross margins deterioration because of the mix of replacement of conventional and LED?
So these gross margins for this quarter, I would say that since it's an abnormal quarter where there was a lot of inventory also, which was kind of taken care into the accounts, I would say that this is an anomaly. Going forward, the gross margins should be normalized, what they have been in the previous quarters. Going forward in the Q2 to Q4, you would see these material consumptions should be normalized.
But the reduction in gross margins is not largely because of the rise in prices, because the crude prices have been sort of subdued in the last couple of quarters.
It's not the pricing. It's more about the revenue dropping and the inventory which was accumulated in the first quarter.
Right, and because of the lower production per se.
That's correct.
That's right, sir. Got your point. Sir, the next question was really on localization. So are we on track to sort of increase our localization content, reduce imports, try and reduce reduce your dependence on imports as we go ahead? Any change of plans over there?
No, I think the company has always had a fair amount of focus on localization. And of course, say with this whole COVID, we recognize that we need to fast-track localization with alignment of our customer needs. And hence, as you said, the insourcing of basically the LED, PCBs. And going forward, we're also evaluating other opportunities where we can basically de-risk ourselves and do import substitution. So it's as progress, as per plan. Maybe we might fast-track a bit as well.
Right. So where are we in terms of localization, in terms of percentage of content, or maybe percentage of our cost? How much is imported content right now?
So it again varies from basically lighting for the four-wheelers as well as the two-wheelers. So if you see basically the localization opportunity in the four-wheelers, it's something around about 20% or so. And in two-wheelers, it would be about 5%.
Right. And when you say fast track, what was the plan earlier and what is it now? If you could just highlight that.
So fundamentally, we see that we would basically be localizing primarily on the LED content because the LED on the headlamp is 60% is basically still, imported, and almost about 30% is on the two-wheeler side. And this we wanted to basically have a localization of about 30% or so. This I think will be faster.
Okay. Any timelines there, sir?
Probably you would see fast tracking. So our original plan was for about a year or so. We may basically cut it to about 9 months. You have to understand that localization needs alignment with customers. So it has to go through the whole testing protocols. So it's not just that you can just do it tomorrow. So hence, we would be fast tracking it from that perspective, given the customer needs as well.
Understood. Perfect. Sir, last two questions. If you could just give me the gross and net debt on books for the quarter, and what is the capex outlook for FY21?
So I will tell Mr. Mehta along with his finance team to address it.
So we are carrying almost around 53 crores of the long-term debt, and the working capital is almost around 320 crores. So the debt equity ratio is around 0.15.
So this 320 crore of working capital debt, will it come down going forward?
Yeah, it will be definitely come down. As I mentioned, because of Q1 is the abnormal situation. So way forward, when the utilization will increase, definitely it will come down.
Thank you. Vimal, we would request you to please come back in the question queue for any follow-up questions, as we have several participants waiting for their turn. Also, we would request the participants to please limit your questions to 2 per participant. The next question is from the line of Pritesh Chheda from Lucky Investment. Please go ahead.
Yeah, sir, slightly a broader question. So this gross block that we have of about 1,200 crores and plus the capex that we have for backward integration at Bawal. So broader question, this 1,200 crore of gross block, what is the peak revenue it can generate? And at that peak revenue with the localization plans that we have, what will be the margins that the company can achieve?
More Jain here. So with the kind of gross block, I believe we should be looking at close to anywhere between 1:1.8 to 2 assets turnover ratio. So considering 12 to 1300 crores, I would say anywhere around 2000 crores top line should be achievable with the current gross block, with the kind of LED penetration and transition we are seeing currently. In terms of margins, as you know, that the company has been attaining close to double-digit EBITDA margins, and we do expect this should perhaps in the coming few years expand by another perhaps 200 to 300 bits.
So
the idea is to close an inch close towards teen EBITDAs in the next few years.
So that 10% that we have should move closer to 13-14% on the peak revenue and the backward integration that we have.
More like 12-13%, yes. That is the endeavor.
And any outside thought or educated guess, the peak revenue, when do you think you could achieve? Is it 2 years down the line or 3 years down the line? Any thoughts there?
Well, difficult to forecast with the current situation at hand. As you know that for a full year, the industry would still be showing a degrowth in the current fiscal year. This is over and above the 18% degrowth the industry saw last year. So if you're looking at a 40% or degrowth in 2 years, the first and foremost question would be how soon can we recover that 40% degrowth, and only then we can talk about growth. So to give you a very broad-based picture, and this is my personal assessment, I do not anticipate that peak revenues being achieved maybe sometime in FY20, later part of FY23.
Peak revenue of your capacity, right? That's what you're putting.
That's correct. I mean, FY21 is a degrowth. I'm saying FY22, we might just come back to where we were, and FY23, we might look at a growth story again, where we could be maximizing our revenue potential with the numbers I had just mentioned to you.
Thank you. Pritesh, we would request you to please come back in the question queue for any follow-up questions. The next question is from the line of Sunil Kothari from Unique Investment. Please go ahead.
Thanks for my hearty congratulations for a very good annual. Sir, we talk a lot about a renewed perspective in annual report. So, if you can qualitatively talk more about what is changing. We are talking about changing our approach to growth, maybe cost opportunity. So if you can a little bit talk about this thing.
So in a broader sense, I think when we talk about a renewed approach, I think number one, it is not necessarily talking about the growth or the external environment. It is talking about the internal way we are doing things. So there is obviously a very strong focus on consolidating capacities, a very strong focus on our cost structures, a very strong focus on redefining the shop floors based on the flexibility and agility which are required in these unfortunate times. So we are looking at more internal issues. Obviously, the external factors, we still have a very strong product development order book. As we go forward, we do expect that with the growth bouncing back in 1 to 2 years, coupled with our internal reorganization of our resources, we should be in a much stronger position as a company than what we are today, both in terms of our cost structures and margins. That is a broad sense of what we mean by redefining and re-looking at the approach with the way the business is run today.
Great, sir. Sir, so basically this internal exercise on internal side, will it change our break-even point, maybe lower fixed cost? Anything quantitatively, if you can talk, what type of cost we have taken, which is sustainable and likely to remain at a lower in terms of percentage level?
Yes, absolutely. I think in Q1 itself, the team has done a great job in looking at all avenues to reduce the fixed costs of the organization, and we have been able to reduce the break-even points, and hence, even with negligible revenues, the loss which we have provided or which we have reported is not as significant as what we had anticipated when we started the lockdown. And as the revival comes back on a month-on-month basis, we are seeing a much positive result than what we had anticipated before. So you're absolutely right that the break-even point will be reduced going forward, and as growth comes back, we should be in a much stronger position.
Great, sir. And if you can ask one more thing. Sir, you mentioned during your opening remarks or reply to somebody this capacity utilization level month on month. If you can repeat again.
No, so in the capacity utilization, what Deepak was mentioning was in the month of July, our manufacturing revenues would be 80% of last year July. In August, it should be upwards of 90% of last year August. And in the September month, it should be 100% of last year, or we might even cross that 100% to show some growth on a year-on-year basis.
Great, sir. Thanks a lot. Wish you good.
Thank you.
Thank you. The next question is from the line of Nikhil Upadhyay from Securities Investment Management Private Limited. Please go ahead.
Yeah, good afternoon and good work for the team to report such numbers in a difficult period. Sir, my questions are basically two, and one clarification. Did you mention we were also looking at entering electronic cables? Because I understand we were looking at entering the HVAC segment. Is electronic cable also a segment we are looking at?
No, so we basically overall would like to complement and get the products which Stanley Electric Japan is basically making for the leaders in lighting, and HVAC panel would be the next product which we would basically be launching with their support in India. So not electronic cables. I did not get that.
Okay, fine. Secondly, sir, if we look at we've done a good job over the last 3-4 years in terms of localizing our production capacities, and a lot of it is already visible in our improvement in margins. Now, if I'll just take a bit longer term perspective here, that if we look over the last 15-20 years, and in this industry there have been changes from halogen lamp and then conventional lamp and now LED, and every time so probably we have a good first mover advantage as of now, but over a period in multiple calls also you've mentioned that the price difference, which is around 3 to 4, can settle down around 2 to 2.5. My question is from the competitive perspective, that if we have to understand our cost structure and the way we have done the import substitution and have a first mover advantage, where would be our competitors in terms of that cost structure? Would we be very most competitive at the pricing point or the price value proposition which we can provide to our OEM players? If you can just help me understand on those two aspects.
I'm not clear. I mean, sorry, you did get a bit this thing. Can you just give a little bit specific point? What would you want me to address?
My point was that over the last 3-4 years, we've been doing a lot of localization and improving our cost structure. So we're reducing our import content, and a lot of indigenization has happened on the cost structure.
Now, a clear benefit of it is that will help us become more cost competitive versus someone who is importing. And in this industry, in our previous calls also, we've mentioned that the price differential which we are looking at currently of 3 to 4 times versus the conventional lamps, that will probably come down to 2.5 times.
Correct.
So we have a first mover advantage in terms of the localization. I just want to understand that what would be our cost differential or value proposition versus our competitor to our OEM. So is it for the competitors also to bring in the same cost dynamics or cost competitive, it will take 3-4 years? Where would they be or in terms of vis-a-vis our pricing or cost of production on the LED part?
Yeah, so let me try and address it in about 2-3 areas. Number one, I think lighting technology, you've seen that every almost a decade goes through a radical shift, and this is not just in India, it's globally, which is there. We obviously have a competitive advantage, as you had mentioned also, first mover advantage due to the relationship which we enjoy with Stanley Electric. And you also have to understand that the Indian market is also largely dominated by the Japanese OEMs, which also do give us those technologies. And hence we are able to utilize their global relationship to get that first mover advantage and do the local indigenization and offer the similar kind of products to the other non-Japanese OEMs as well. In terms of the cost structure, I think it's a continued effort. We are very clear that we will continue to have localized technologies which are suitable for the Indian market, and we would also use that technology to also have skill building in our teams so that we are able to give a much more localized. We personally feel that as the technology becomes more complex, for example, LEDs is becoming more and more electronics. Going forward, it would be when the Indian market would be ready for it, but there would be a lot of sensors, a lot of software, a lot of basically control unit integration also in the lighting systems. So we are pretty confident that we will have that kind of skill, and we are slowly developing and investing in that. Of course, the investment portfolio as well as the capacity and capability to invest, because as the technologies develop, you have to invest a lot more to localize these technologies, and hence a healthy financial balance sheet is also very, very important. And if I compare it with the other competitors into the market, Amisha, that definitely for Lumax Industries is a competitive advantage. And last is the segment distribution which Lumax enjoys, where we actually do cater to all segments, be it two-wheelers, four-wheelers, fast cars, and even our recent entry into the commercial vehicles as well as to the agriculture space to actually, again, with this technology shift happening, we would be able to garner more market share in these segments as well, what we are currently having. So I think that's the overall way, and of course, with volume, your cost structure gets more distributed. We have invested over the years a lot in localized R&D capability to becoming technologically self-reliant, and also have basically invested in Taiwan office for R&D. So I think all those investments, as the scale goes up, as basically all segments start adopting, we will be able to have a much more efficient cost structure than today.
Thanks a lot. Just one small question. When we say that our front lighting is 64% and rear lighting is 22%, that would be by value. Can you help me understand by volume? So if there is, say, just keeping it basic, like if in Pulsar there is a LED front light which we are providing, would the OEM go to someone else for a tail light, or would does it like for the whole product or the whole product we get all the lighting, or is it like a piecemeal approach which an OEM takes?
Okay, so the sourcing has significantly changed over the years. When I say over the years, the sourcing strategy at one point of time used to be, okay, on one model, like I'm just giving an example, Pulsar, you could have 2 headlamp suppliers or 2 tail lamp suppliers. Now it is probably model specific. However, within that model, Amisha, the OEMs to again de-risk itself probably does on the front end lighting to someone and rear end lighting to someone else. But it does not mean that front end is again distributed to two players. It's probably then captured with one player itself. And overall, there's a broad base for almost all OEMs, a strategic sourcing, which basically defines who their strategic partners are and how much from the total buying they would basically be having a share balance with the competitors as well. So I think that's where the current is. So very simply to put your answer your question, if you have basically one model, headlamp would go to one supplier. A tail lamp usually goes to other supplier. However, in our case, we have seen, and I give an example like Swift, we do have cater to the complete model on the lighting range.
Thank you. Nikhil, we would request you to please come back in the question queue for any follow-up questions, as we have several participants waiting for their turn. The next question is from the line of Anubhav Rawat from Monarch Networth Capital Limited. Please go ahead.
Hello. Yeah, hi, good afternoon, sir. Just a couple of questions on a related party transaction. So, sir, in FY19, we had around 217 crores of purchase of raw materials from Lumax Autotech, and it came down to about 98 crores, right? So this is, I presume, because we acquired their assets. So is this a sort of rough number of 100 crores? I mean, will this be the normal run rate, right? Or will it further come down?
Sanjay, do you want to take that?
Yes, sir, because I think you're comparing with the 2 years figure. The last year there was the LED, which we have transferred that plant to now in LIL, I mean to sold the assets to them. So I will just want to, just because both the companies are audited by the Big Four, so whatever the related party transaction is taking place, it is on the arm's length basis, and it is as per the need, as per the requirement of the particular time. So it is not less or high, it depends on the circumstances.
Okay, understood. And sir, just wanted to understand, we have, we procured raw materials from Lumax Ancillary Limited and Bharat Enterprises. So what is the nature of these purchases?
We are purchasing wire harness from the Lumax Ancillary and Bharat Enterprises because of the stringent quality control required in that.
Okay, and what about Lumax Ancillary Limited, sir?
Wire harness. Both wire harness.
Okay, fine. Understood, sir. Thank you. Thanks a lot.
Thank you. The next question is from the line of Pankaj Bopade from Axis Securities. Please go ahead.
Thanks a lot for taking my question, sir. Sir, two questions. First one, you mentioned that the opportunity for imports, substitution of imports is just 20% for four-wheelers and 5% for two-wheelers. But we also mentioned that the margins would increase by 2 to 3% over next 2 to 3 years after normalizing of the demand. So there is a disconnect between these two things. Could you throw more light on this? And secondly, do we have any scope for benefiting from the China Plus One strategy followed by various OEMs?
Okay, so I think I'll answer the first question first. I think you're presuming that all the margin improvements will only come by localization. I think that's not the case in point. I think the margin improvement plan is primarily driven by better volume optimization, better product mix transitioning towards LED, very, very cost-efficient programs which we are running in the company and has been fast-tracked because of this COVID-19 experience, and of course, due to the import substitution. So it's a mix of all the parameters and a consistent approach towards cost rationalization, which would actually help us on margin improvement, given that we expect demand to further firm up and hopefully, go. So as growth comes in, we should get better margins. Second point, I think you're talking about China Plus One strategy. I think we'll have to very closely monitor and watch how, our OEMs are basically going to respond towards that. And will they be shifting more and more certain products which could have export opportunity. We have to also understand that in global relationship, we have a very strong partnership with Stanley, which we have to respect their territory. So we will continue to evaluate that and see whether and forward we would have certain export opportunities which comes through for the company.
And how about this Atmanirbhar call given by PM? So do we see any opportunities growing for us? May not be only in LED segment or lighting segment or in any other product segment?
So this company, Lumax Industries Limited, will be focused on lighting segment, which basically will be catered along with our partners to Stanley. As I just mentioned, that the HVAC panel is a new opportunity which we are evaluating. Atmanirbharta, I think let me clarify that we at least see that as not just localization, but how do we enhance competitiveness so that Indian manufacturing can be recognized world over. I think that's the key, and we are always in dialogue with Stanley that how do we basically improve our competitiveness, and at any given opportunity, if Stanley feels that we can use the Indian manufacturing base to cater to export requirements for the global processes, we would be very happy to do that.
Thank you. Pankaj, we would request you to please come back in the question queue for any follow-up questions. The next question is from the line of Ashutosh Tiwari from Equirus Securities. Please go ahead.
Yeah, hi. Firstly, like this Honda Activa model has shifted to both halogen and LED with two variants. The BS6 earlier was completely LED. So whatever volumes you're seeing over the last 2-3 months, what's the mix? Is it the halogen is much bigger share in that model, or LED is also a decent share?
So maybe Vineet, you can answer that, please.
One important thing is that, first quarter we should not take as a marker for anything because different customers took different strategies.
No, so I'm not talking about first quarter. I got a point because anyway sales was not there. I'm talking about recent months.
Yeah, so recent months, both LED and halogens are taking, priority from customers. First, the vehicles related to halogen took priority because of the rural market. But now we see a significant increase in LED also.
Okay. So this Activa, the 40-50% could be LED on sustainable basis, like going ahead over the next 3-4 months?
Yeah.
Let me answer it in a very different perspective, Deepak here.
Okay.
The market agility is so much that you really don't know, especially on a model which is basically having both. And currently the halogen is there. Tomorrow the LEDs. We personally feel that LED will come back very fast because as the market normalizes, it is very, very difficult when you have given customer a choice on a specific model of a higher technology. They basically would revert back to older technology. And though, there is always a price differential on models and a price pressure, but we have to see. You have to also understand that the recent transition to BS6 has obviously put in a lot of price pressure on the vehicle pressure. And of course, it was further compounded by COVID-19. So I think we'll have to wait and watch. It would be very difficult for us to say that, oh, listen, it's all going to be halogen or it's all going to be LED. But the point is that how the company will quickly react to the agility. And hence we have those flex lines and the capacity that if the, let's say, LED requirements or halogen requirements shoot up considerably, we will be able to cater to both the demands.
Okay. No, actually, I just understand how the things are moving right now. Obviously, what we've seen in recent months is that, like say, even in the deluxe segment of motorcycles, the higher price model is selling more. So there's no down trading seen so far. So maybe it may not be the ratio will be very different on VS6. So just want to understand that part. Secondly, obviously,
we also agree with that stance. But again, I'm saying it's too premature just to take a 3 or 4 months outlook on this.
Got it. Secondly, obviously, we are localizing the PCB and other electronic parts of LED. And also with COVID, we must have taken a lot of cost-cutting measures. So will it be fair to assume that when our revenue goes back to FY20 levels, maybe in FY22, that time the margin should be reasonably higher than what, let's say, maybe around 1% or even higher than that compared to FY20 levels?
Absolutely. I think Anmol in previous, just had mentioned that we would aspire to basically reach higher margin levels of what we had been basically doing.
Also, in 22 itself, we can see better margin when things normalize maybe.
It also depends on the market conditions, though. A lot depends on market conditions.
Oh, yeah, obviously, but I'm just saying that if we assume that 20 goes to 22, then okay, thanks and all the best. That is all on my side.
Thank you. Due to time constraints, that was the last question. I would now like to hand the conference over to Mr. Deepak Jain for closing comments.
Well, I would like to thank everyone for joining on this call. I would like to restate that this quarter was an exception, and we remain confident to grow with the numerous opportunities and outshine the market. I hope we've been able to respond to all your queries adequately. For any further information, please request to get in touch with SGA, our Investor Relationship Advisor. Stay safe and healthy. Thank you once again.
Thank you. On behalf of Lumax Industries Limited, that concludes today's conference call. Thank you for joining us, and you may now disconnect your lines.
Thank you.